Stop scrolling and look at your portfolio right now. If you see a massive chunk of your money sitting in bonds yielding 3%, or if you're blindly dumping cash into an international fund that hasn't moved sideways since 2008, you are not investing. You are engaging in financial nostalgia. You are investing for a world that ceased to exist 20 years ago. The rules of money have been rewritten. The safety nets of the past, like the 60-40 portfolio, are now traps that will bleed your purchasing power dry through inflation and missed opportunities. Today, we aren't just tweaking your portfolio. We are tearing it down to the studs and rebuilding it into a wealth-generating machine designed for the reality of 2026. This is the blueprint for the modern Titan portfolio. I'm Tony, and welcome to Grow with Tony. Disclaimer: I am an investor sharing my strategy, not a financial advisor. This portfolio is designed for the accumulation phase with a 10+ year time horizon and high risk tolerance. If you are retiring soon or need stable income, this may not be for you. Do your own research before making any moves. Now let's cut through the noise. To understand why we are building this specific portfolio, we have to understand why the old advice is failing you. For decades, the gold standard was the 3-fund portfolio championed by the boggleheads. It was elegant in its simplicity: total US market, total international market, and total bond market. The logic was that when US stocks zigzagged, international stocks would zag, and when everything crashed, bonds would skyrocket and save your hide. That logic is broken. Let's look at the data. In 2022, we saw something that terrified traditional investors. Stocks crashed and bonds crashed with them. The inverse correlation, the idea that bonds go up when stocks go down, failed. Why? Because we entered an era of rising interest rates and sticky inflation. Holding 40% of your wealth in an asset class that loses value when rates rise is not safety. It is guaranteed destruction of capital. In international, look at the chart. For the last 15 years, the S&P 500 has absolutely crushed international developed markets. Why? Because the world has changed. In 1980, if you bought Coca-Cola, you were buying America. Today, if you buy Apple, Microsoft, or Google, you aren't just buying America, you are buying the world. These companies generate massive percentages of their revenue from Europe, Asia, and South America. You already have international exposure by holding the best US companies. Buying a separate international fund today often means you are just buying lower quality companies in slower growing economies just for the sake of checking a box on a diversification checklist. So we are going to fix this. We are going to build a portfolio that respects the need for stability but refuses to accept mediocrity. We call this the modern Titan portfolio. It consists of just 3 ETFs. No complex trading, no options, no crypto gambling, just 3 engines driving your wealth. The allocation is simple: 50% foundation, 30% defense, and 20% offense. Let's start with the foundation. 50% of your money goes into VTI, the Vanguard Total Stock Market ETF. Why VTI and not just the S&P 500? Because VTI is the ultimate bet on American capitalism. It holds over 3,500 companies. You get the giants like Apple and Amazon, yes, but you also get the mid-caps and the small caps. You get the next Tesla before it becomes Tesla. You get the entire ecosystem of the US economy. VTI is self-cleansing. This is a concept you need to understand. In 1990, the top companies were General Electric and Exxon. Today, they're tech giants. In 20 years, they might be biotech or AI companies. You don't know and I don't know. The beauty of VTI is that we don't need to know. As companies fail, they drop out of the index. As new winners rise, they are added automatically. It is a survival of the fittest machine that runs on autopilot. By putting 50% of your wealth here, you are positioning yourself to capture the wealth creation of the entire US market. You are the house, and historically, the house has tended to win over long periods. Now let's talk about the controversial part, the defense. We are deleting bonds from this portfolio. I repeat, 0 bonds. If you have a long time horizon, 10, 15, 20 years, bonds are a drag, but we still need stability. We still need something that lets us sleep at night when the market drops 20%. We replace bonds with SCHD, the Schwab US Dividend Equity ETF. We are allocating 30% here. This is your shield, but unlike bonds, this shield is made of titanium. SCHD doesn't just buy any stock with a dividend. It is highly selective. It tracks the Dow Jones US Dividend 100 Index. It screens for companies with a record of paying dividends, sure, but it also looks for cash flow to debt ratios and return on equity. It essentially filters for quality. We are talking about companies like Home Depot, Chevron, PepsiCo. Boring? Yes. Powerful? Absolutely. Here is the magic of SCHD. In a bull market, it will go up, maybe not as fast as a tech stock, but it goes up. But in a sideways market or a bear market, this is where you win. These companies pay you to wait. They pay you quarterly dividends that you are going to immediately reinvest. Think about the psychology of a crash. When your tech stocks are down 30%, you feel panic, you want to sell. But when you look at your SCHD holding, you see that the share price might be down, but the dividend check actually got bigger because you reinvested at lower prices. This is the income snowball. It turns a market crash from a disaster into a discount shopping spree. SCHD provides the psychological safety net that bonds used to provide, but without capping your upside potential. It defends your portfolio not by staying flat, but by generating cash flow that accelerates your compounding. So we have the foundation VTI and the defense SCHD. That is 80% of the portfolio. If you stopped there, you would do great, but we are here to maximize wealth. We need an engine. We need an afterburner. This brings us to the final 20%, the offense. We are going with VGT, the Vanguard Information Technology ETF. Why tech? Why concentrate 20% of your net worth in one sector? Because technology is not just a sector anymore. It is the deflationary force that powers the entire global economy. Every bank is a tech company. Every retailer is a tech company. Healthcare is becoming tech. VGT concentrates your money into the companies that are actually changing the world. Apple, Microsoft, Nvidia, Visa, MasterCard. These companies have margins that other industries can only dream of. They have balance sheets with more cash than some small countries. Critics will say, Tony, that's too risky. What if tech bubbles burst? Yes, tech is volatile. You need to know the numbers. VGT dropped nearly 40% during the dot-com crash and over 30% in 2022. Because this portfolio has zero bonds, the volatility will be higher than a traditional portfolio. Between VTI and VGT, you are looking at roughly 50% exposure to the tech sector. This is a concentrated bet, not a hedged one. That is the price of admission for superior returns. But look at the last 10-20 years. Tech has consistently outperformed the broader market because productivity growth comes from tech. By allocating 20% here, you are tilting your portfolio towards the winners. You are acknowledging that in the digital age, the companies building the infrastructure of the future will capture the majority of the profits. This 20% allocation is your get-rich bucket. While SCHD provides more stability and VTI keeps you diversified, VGT is working to pull your average annual return from a respectable 8% to a potential 12 or 14% based on historical data. However, remember that past performance does not guarantee future results. Over 30 years, that difference is millions of dollars. So how does this modern Titan portfolio work in practice? Let's walk through a scenario. Imagine it's a booming year, the economy is roaring. VGT is going to skyrocket, pulling your portfolio value up significantly. VTI will do well, SCHD will chug along, you are making money hand over fist. Now imagine a recession hits. Inflation spikes, interest rates go up, tech gets hammered. VGT drops 25%, panic sets in on Wall Street. But you look at your portfolio. Your SCHD portion is holding up better than the market because people flee to quality and cash flow during tough times. Your dividends from SCHD come in. You take those dividends and instead of buying more SCHD, you use them to buy VGT while it's on sale. You use the dividends from your defense to buy your offense at a discount. This is dynamic rebalancing. You are constantly feeding the lagging asset with the cash flow from the performing asset. This structure allows you to be aggressive without being reckless. It gives you permission to seek high growth because you know you have a fortress of dividend-paying quality companies covering your back. Let's address the critics. Some will say, Tony, this is performance chasing. You're just picking what did well in the last decade. That is a fair critique, but it misses the fundamental shift in the economy. We aren't just picking random winners. We are betting on three fundamental truths. 1. The U.S. economy is the most robust in the world, VTI. 2. Companies with real cash flow and strong balance sheets survive crises better than speculative ones, SCHD. 3. Technology is the primary driver of human productivity and economic expansion, VGT. Unless you believe the U.S. will collapse, companies will stop caring about profits, or we will go back to using typewriters and abacuses. These three truths remain valid for the next 20 years. Now let's talk about implementation. How do you actually do this? Step 1. Assess your risk tolerance. If you are retiring in 2 years, maybe you do need some cash or bonds. This portfolio is for those in the accumulation phase. If you are 20, 30, 40, or even 50 and plan to live to 90, you need growth. Step 2. The setup. You open your brokerage account. You set your contributions. 50% VTI, 30% SCHD, 20% VGT. Step 3. The behavior. This is the hardest part. The math is easy, the psychology is hard. There will be a year where international stocks beat US stocks. There will be a year where bonds beat stocks. The financial news will scream that the US is dead or tech is a bubble. You have to ignore it. The power of this portfolio comes from consistency. It comes from the compounding of dividends and the long-term upward drift of innovation. You need to commit to this for a decade, not 6 months. A decade. You need to automate your buying. Every paycheck money hits the account and it buys these 3 tickers. You don't look at the price. You don't try to time the dip. Time in the market beats timing the market every single time. Finally, I want to talk about the why. Why are we doing this? We aren't doing this to see a high score on a screen. We are doing this for freedom. The modern Titan portfolio is designed to get you to your financial independence number faster than the traditional slow lane methods. VTI ensures you never miss a market rally. SCHD ensures you have cash flow to live on eventually without selling your principal. VGT ensures you beat inflation and grow your purchasing power. It is a complete ecosystem. It is simple, it is low cost, and it is brutally effective. You don't need a hedge fund manager taking 2% of your money to underperform the S&P 500. You need discipline, you need a plan, and now you have one. So here is your homework. Go look at your current holdings. Are you holding dead weight? Are you holding assets that haven't served you in 10 years just because you're afraid to change? It's time to modernize. It's time to take control. If this video gave you value, do me a favor. Smash that like button. It helps the algorithm find more people like us. Hit subscribe and ring that bell so you don't miss the next deep dive. And listen, I want to know what you want to learn next. Drop a comment below. Tell me what specific topic or ETF you want me to tear apart in the next video. I read the comments and I'll make the video for you. But if you've got nothing to ask, that's cool too. Just say hi. I'm Tony. This is Grow with Tony. Stop playing safe, start building wealth. I'll see you in the next one.